Hi everyone, my name is Bruno, and this is a joint work with Anna on insurance contract specification in the upstream sector of the oil and gas industry. Okay, so just to put some context on, in this work we are interested in the upstream sector of the oil and gas industry, basically exploration and production assets. And these assets are known by capital intensive projects and highly complex hazardous associated recovery production process. So as a consequence, it has been seen throughout history several large accidents with multimillionaire damages. For instance, the Macongo accident in 2010, and therefore oil and gas companies typically seek for different types of instruments to deal with these potential extreme financial losses associated with these events. So one of those instruments are actually an insurance. So basically, oil and gas companies hire insurance to hedge or at least to cover this extreme financial losses from the exploration production assets. So an overview just to put some context on. So insurance is basically a bilateral contract that gives the buyer, which for us is are the an oil and gas company, which also called policyholder. So gives this buyer the benefit to be financially compensated by the seller, which is some insurance company, also called underwriter. So financial compensated by this underwriter in the context, in the case of an occurrence of an event. So, but in the return, the policyholder, the oil and gas company, pays a premium to the insurance company to compensate or to cover the contract. And the main problem and the main challenge in this problem that usually appears in technical literature is how to fairly balance the premium magnitude paid by the policyholder compared to or respect to the likelihood of the event occurrence and the financial recovery. And what we observed in technical literature is that this problem has been extensively studied from multiple angles. For instance, how to price this insurance contract. However, in this work, we kind of take a different path and take the viewpoint of a policyholder and propose or study an holistic methodology to, instead of price the a given insurance contract, we specify the contract parameters such that there's a utility balance between the underwriter and the policyholder. Okay, so this is the agenda of this talk. I will begin by modeling the insurance contract considered in this work. So to begin with, we consider two major uncertainties. The first one is the number of accidents that occur during the contract maturity. And given this number of contract accidents, we are also considering uncertain the financial loss associated with an accident. So the total magnitude of financial losses involved during the maturity of the insurance contract can be given by this expression here. It's basically the sum over an uncertain number of accidents of all financial losses incurred by each accident. And just highlighting again, the key purpose of an insurance is thus to financially protect the policyholder against extreme financial losses or more precisely extreme values of this L function here. Okay, so the insurance contract that we are studying in this work actually has two major features. One that we called a major one or a local one, and one that is called a global one. With respect to the local one, we have two parameters. Deductible, which basically means that it's an indication of an initial threshold in which the magnitude of the accident loss is due to the policyholder. So up to this T1 value, all the financial loss is due to the policyholder, to the oil and gas company. And then a second parameter called local or coverage limit, which is basically indicates an interval in which uh, the, the, the magnitude, the financial magnitude, is covered by the underwriter, the insurance company. So, with respect to the global one, we have a similar procedure here. So basically, what it means is that if we sum up all the individual indemnities brought by all the accidents, there are some threshold in which the underwriter is obliged to cover. So from a global perspective, basically, if the total amount of loss overcomes this threshold T3, this insurance contract basically ceases. So under this context, the contract specification problem can be stated basically by understanding the methodology, or not the methodology, but the functions that each counterpart are due. For instance, for the buyer counterpart, we have this expression here in green, which is basically a way to reorganize the piecewise linear functions that recover the insurance contract, and the insurance company, the amount that is due to the insurance company is basically the total amount minus what is due by the policyholder. Okay, so basically the problem that we are studying is, well, what are the optimal parameters that the policyholder must decide in order to maximize the oil and gas company global risk-adjusted value. Of course, this value is composed by both the losses, which is given by this function, and also the premium paid by the seller, paid to the seller. So the problem is stated as basically this one. We have here in the objective function exactly this risk-adjusted global value. We assume this convex combination between the expected loss under the insurance contract and the CVAR of these losses, and the CVAR basically here aims at introduce some risk averseness into the problem. And on the other side, the premium is recovered using the so-called safety loading framework. So basically the idea is that, well, insurance is typically call for premium the expected value of the amount that the insurance will cover. So so by making this assumption, what we assume here is that, well, the premium must be at least the expected indemnity due to the insurance company plus some loading factor, this variable tau, that recovers the risk aversion of the insurance company due to the insurance contract. Okay, so in this context, by stating this problem, what we observed is that, well, this problem may be too difficult to solve because the main functions are nonlinear, and also the problem is stochastic. But with respect to the former, the nonlinearity of the problem, since they are piecewise linear functions, we can rewrite these functions using some mixed integer linear constraints, and which is suitable for off-the-shelf solvers. Okay, so the critical aspect to solve this problem, to at least characterize properly this problem, is how to model the uncertainty. Typically in technical literature, this representation is assumed some a priori known probability function known by the decision maker. However, in practice, what we observed is that industry know that such representation plays a key role for an efficient contract design. So by taking advantage of these and taking advantage also of the problem, we make use of this idea of precursor data with safety barriers to probabilistically characterize the financial magnitude of the covered incident. So basically the idea is that, well, since accidents constitute some rare events, so data associated with these events are kind of scarce, so challenging, so it's difficult to probabilistically estimate a density function. So what we applied, or what we studied, is that, well, by discriminating the process structure, for instance, here's some barrier here, and which leads to another barrier, which leads to another barrier, we kind of model all the physical elements probabilistically, so we improve the reliability over the likelihood of this estimation, giving and consequently better representing the financial magnitude of some accident. Okay, so by combining these 2 points, we applied some numerical experiments, and the numerical experiments are based on some realistic case of the Brazilian oil and gas Brazilian oil and gas company. We assume these parameters here, so the number of accidents comes from a Poisson with parameter 6 and a risk aversion of half, alpha of 0.9, and all these parameters here. And also the probabilistic representation has 2 facets. The first one is the probability of fails, which is given by these parameters here, and given that given that we have the success between among these barriers, we also have the probability of the probability distribution given by these triangular distributions to represent the actual financial magnitude. Okay, so we begin by presenting some sensitivity with respect to the parameters of the problem. First, we provide some sensitivity with respect to the loading factor. We found that, of course, or as expected, as we increase this variable, both the premium and the objective function also increases. But we highlight that the rate of increase in the objective function is higher with respect to the premium. So what we observed is that a greater loss on the risk-adjusted value for the policyholder with respect to the premium paid to the underwriter. Also, we provide some sensitivity analysis with respect to the risk aversion parameter. We found that the optimal solution is not, at least for the T1, the deductible, is not impacted by the risk aversion, but we observed that the other parameters are impacted in a stepwise fashion. And we also run some benchmark analysis with 3 known policies that are done with 2 known policies done by the industry and basic one of an uninsured company. And what we observed is that, firstly, the standard deviation or the variability of the losses given by the optimized or the proposed approach reduces significantly with compared to the benchmarks. And also, although in average in the median case, the median metrics are kind of similar, we observe that the CVAR, or the 5% worst cases, the worst scenarios, are significantly higher in the benchmark compared to the optimized one, and roughly twice compared to an uninsured company. Okay, so with this I conclude my talk. Thank you.